Did I stop recording? Oh, another crazy. Anyways, okay. So basically, assuming that the company adopted periodic system and using LIFO, we just didn't care about the state of the sales. We just assumed that at the end of the year, when the company is making adjusting entries, that adjusting entries, the company will be using this, the latest 600 units for the sales, even though the sale was made prior to the purchase. That's periodic system. Now, if the company follows a perpetual system, yes, you're right. On July 7th, 17th, the company will be using these 300 units for computing the cost of goods sold. So the question becomes, how do you compute your cost of goods sold depending on which inventory system you're using? Okay, and I'll give you an example going forward. Any questions before we move on?
Yes, can you go over that just one more time? Sorry about the periodic system.
Okay. Okay. So assuming the company adopted this periodic system, okay, like we said previously, we do not have a real-time tracking system, or there is no continual basis of keeping the inventory stack. So what that means is that, so according to this example, on July 17th, the company sold 300 units. So 300 units right here. If the company followed periodic system, since there is no tracking system, there will be an adjustments at the end of the year. So on December 31st, the company will assume that this 300 units will come from this 600, the latest purchase in the inventory stack. Now, if the company is following perpetual system, as there is a continual tracking system, on July 17th, the $300 units that are sold on that day will come from these 300 units, because on that date, the 600 units had not been purchased at that point of the sale. Okay, so depending on which system the company is using, the cost of goods sold also will change following the system. Okay. Any
Thank you.
clarifications?
No, that was great. Thank
Mm.
you.
Any other questions?
A quick question.
Mm.
Yeah, so are both of the systems periodic and perpetual falls under gap, or
Oh, yeah, I mean, like here, most of the companies use perpetual system, but both are gap. Yeah,
both are gap?
yeah.
And I guess so for the periodic, it seems like they don't keep track of what goes on throughout the period, and at the end they pretty much capture everything. So how do they actually calculate the ending inventory at the end for periodic?
So,
I guess.
I mean, another example that I can give you for perpetual inventory system, when you're selling your inventory, you can easily calculate the cost of goods sold because you keep track of all the inventory history. Now, for periodic system, what's really happening is at the end of the year, when they are actually adjusting the inventory, they individually, basically, what do you call it? Uh, individually count the inventory at the end of the year.
I
And then when
see.
they are counting, they take this difference between the beginning and the ending count of an inventory. And from there, they are calculating the cost of goods sold. That's the difference. Okay.
Thank
Any other questions? Okay. So, I mean, using the example or the actually doing the problem set will give you much a clearer picture to understand. So I will do the calculation for you. Okay. So we have 2 layers of systems. So let's start with periodic. Okay, periodic system. and LIFO. Okay. So using periodic system LIFO, okay. So this July 17th and 300 units right here will come from the latest stack right here because you're not continually checking your inventory. So you have 300 units times 11 for the July 17th sales. Oh, you know what, actually? Oh, it's okay. So, you know what, actually, I don't want to do this first. So you have December 15th right here. So December 15th of 500 units. Okay, so let's start with the latest. So for latest December 15th, you have 500 units that are most likely coming from this 600 units. So you have 500 units times 11 plus you still have 300 units, okay, for July 17th. And since you have 100 units left from that latest stack, you're going to be using that stack times 11 plus 200 units times that 9 right here, second stack. Okay, that's for the cost of goods sold. So you have 5,500 plus 1,100 plus 1,800. So that will give you a total of 66, 76, 80, 85, 84. $8,400 for cost of goods sold. Okay. Under periodic system, let me just write it again. System with FIFO. FIFO. Okay. Starting with July 17th right here. So you're going to be using the first 100 stacks. So 100 stacks times 7, plus you still have 200 units out of 300 times 9, okay, from that stack. Plus on December 15th, you're still selling 500 units. So you used 100 units out of 300. What's left is 200 units, okay? So you have 200 units times 9 plus the rest comes from the
Did you
latest.
use 200 units?
What was that?
On what's it called?
Oh,
Use
here.
200.
Oh, yeah, that's right. So you're not, instead of using 200, you're using 100. Good catch. 100 times 9 plus the rest, 400 times 11. Okay, so the first 300 is the, let me just write again. And then the 500 units right here. What's going on here? There you go. Okay, so if you do the math, you have 700 plus 1,800 plus 900 plus 4,400. So that's 25, 34, 74, 7,800 cost of goods sold.
Professor, why aren't we recording the sales? Because it says 500 units sold for 1,500 each. I mean, $15 each. Why are we ignoring that?
Oh, that's for revenue. We're talking about cost of goods sold.
Oh, okay. Thank you.
Okay. Oh, lots of calculations, right? So try not to make a mistake in your calculation during an exam or quizzes, because definitely, like I did here, if you miss just one thing, you will definitely have a wrong answer. So that's for periodic. So again, regardless of the timing of the sale, you're just gonna assume this entire tower of inventory stack and then start from there. Now, if you're following perpetual system, let's move on to perpetual. Perpetual, let's start with LIFO to be consistent. Okay. So on July 17th, this 300 unit will come from the second stack, not 600 stack, because at that point of July 17th, we did not have that 600 units because that was made on October 19th. So what that means is the entire 300 will come from the second stack. So for cost of goods sold, you have 300 times 9. That's it for 27. And on December 15th, you sold 500 units, okay? Because that's after this October 19th, you will use 500 out of 600 units, okay? So that's 500 units times 11, that's 5,500. So in total, that's 8,200 of cost of goods sold. Okay. Now, let me go down a bit. So assuming that the company adopts perpetual FIFO, okay, let's go up. So this 300 units that were sold on July 17th, it will come from first, this 100 units, and the 200 units will come from the second stack. Okay, so, so 100 units times 7 plus 200 units times 9. Okay, and then on December 15th, you sold 500 units. So since we used 200 units out of 300, we still have 100 units left for the second stack, and the other 400 will come from the third stack right here. So you will have 100 units times 9 plus 400 times 11. So that will give 700, 1800, 900, 4400. So in total, 25, 34, 78 cost of goods sold. Okay. Now, regardless of periodic system, okay, regardless of periodic system or perpetual system, if the company adopts this FIFO method, you will always have the same amount of cost of goods sold. Here, 78 cost of goods sold, 78 cost of goods sold. Okay. But for LIFO, the cost of goods sold will definitely be different between these two systems. Okay. Any questions on this? Okay, so I understand that there are lots of calculations arising from which inventory stack we'll be using, but as long as you draw this, the tower of inventory and which inventory is being used for the sale on that particular date, you will be able to calculate the correct amount of cost of goods sold, given that you do not make any mathematical mistakes, okay? So that was with respect to the cost of goods sold. Let's talk about revenues since you're making sales, okay? But that's easy. I mean, you sold 300 units for $15, so that's 4,500 revenue. You on December 15th, you sold 500 units for $15 each, so that's 7,500. So in total, you're making a revenue for the amount of $12,000. And when you're making a revenue, depending on the payment terms, let's just assume that the customer used a credit card, accounts receivable of $12,000 and sales revenue of $1,200. Okay, so that's respect to the revenue. Let's talk about the inventory. So you are going to be reporting debit cost of goods sold for some amount and then inventory with the same amount. Now that number will be different depending on which method you're using. So assuming that the company uses perpetual system and FIFO method, the cost of goods sold will be 78. So you're going to be reporting 78 cost of goods sold, already 78, and then 78 right here.
Those are balance sheet adjustments, right? Inventory, is that is that a reduction of inventory by 7,800, right? And
Yeah,
then
but this is not an adjustment. This is just actually recording according to the transaction. You're not making any changes at the end of the year.
it's just reporting the change in inventory.
Mm-hmm.
And then the 7,800 is, well, it's clear to me that you're reducing an asset of 7,800.
Yeah.
Cost of goods sold is, to me, is that an expense, right?
It's an expense, yes.
Okay, fine. So the second item is balance sheet, first item is income statement.
Yes. So
Okay.
yeah. So we briefly talked about this matching principle. So whenever you are recording a revenue principle. So whenever you're reporting a revenue, there's got to be some expenses associated with it. So as you're reporting a revenue, you're going to be reporting expenses or cost of goods sold in this case. And as you are selling your inventory, by crediting your inventory, you're reducing your inventory right here. Okay. Any other questions? So this part requires a lot of practice. But as long as, again, as long as you do not make any mistakes, you'll probably be in a good shape. Okay. Now, another thing that I want to mention between these two systems is that for perpetual system, whenever you purchase a new inventory, for example, let's just use this example. When on April 25th, when the company purchased this inventory, you are going to be recording debit inventory for 2,700. Okay. Probably accounts payable for that inventory. I don't know, but this is going to be the journal entry basically. You're increasing your inventory for the purchases. Now, if the company has periodic system, okay, the journal entry that's going to be recorded on April 25th will be slightly different. So that you're going to be debiting here purchases. There will be some the explanations, inventory, for example, with the same amount, 27, and accounts payable, 2,700. So that's basically the difference. For perpetual, you directly increase your inventory by the amount, by the respective amount. For periodic system, you do not directly increase the inventory, but rather you have this temporary account called purchases instead of recording on the inventory. Now, the reason why we use this temporary account is the fact that periodic systems do not have a continuous tracking system. Okay. Now for perpetual, since you are continually tracking which inventory is being purchased and which inventory is being sold, you can directly increase this inventory because there is a 99% certainty of that purchase. But for periodic, since the staff working at the warehouse do not technically check this inventory in a continual basis, you cannot really use inventory line item for the purchases. And that's why in accounting, we use this temporary line item called purchases to indicate that we purchased some inventory during the period. And then the fact that we are using this temporary account will require us to make an adjusting entries at the end of the year. or at the end of the period. Okay. So in this case, let's assume that there's nothing happened for the rest of the period. This purchase will be credited, okay, 27, and debit inventory, 27. Again, at the end of the period, when the staff comes into the warehouse and actually manually count the number of inventories, then they can 99% sure that we have the inventory that was purchased on April 25th. Okay, that's when you convert this temporary purchase account into permanent inventory account. Okay, but that's the difference between periodic system and perpetual system. Any questions? Oh, okay. So that's good. So here, so the fact that the company is recording inventory on April 25th, we can safely assume that the company adopted perpetual inventory system. Okay. If we see purchases right here, that means the company is using periodic inventory system. So on April 25th, you're going to debit inventory by 2,700, credit accounts payable for 2,700. Now on July 17th, the company sells inventory on account. Okay. Now, like we discussed previously, the selling price was $15. 300s were sold. So that means you have accounts receivables for that amount and then sales revenue of 4,500. And at that point of the sale, you are recording the cost of goods sold following FIFO here, following FIFO 2,500. And you're going to be at the same time reducing your inventory by crediting inventory by 2,500. Okay. So as you're making sales, you are reporting the cost of goods sold to indicate the decrease in inventory. Okay. So this is basically an illustration with respect to the inventory T account. So you're starting with 700 at the beginning. You purchased 2 times during the period, and you sold again on 2 occasions on July 17th and December 15th. And the balance, according to the FIFO, the balance is 2,500, 2,200. Okay. So, but again, I really strongly suggest you to go back to this example and then calculate with your own hands. That will provide you more clear picture with respect to how the company is going to report the cost of goods sold as well as the ending inventory. Okay, depending on which method you're using. LIFO adjustments. So basically, I talked about this previously. LIFO reserve, in order for investors to be able to compare between 2 companies that use LIFO and the other company using LIFO, you need to provide some differences. How had the company used LIFO, what would be the ending amount for inventory on the LIFO? And that's going to be the number that's being reported on the LIFO reserve. Okay. Any questions? But that's mostly the difficult part for this chapter. So if you are comfortable with the calculations that we did so far, you are going to be in pretty much good shape. But if you're just confused about anything, please make sure that you do calculate on your own hands and then see if you get the consistent answers with the slides. Okay. Now that was with respect to inventories and cost of goods sold. Let's talk about some real world. So there are freight charges, so shipping costs basically. So if the seller is sending out products to the buyer who's paying for a shipping cost and who is going to be responsible for reporting that shipping cost. Okay, so freighting is the shipments from the suppliers. Freight out is the shipments to customers. Who's going to be reporting the shipping cost, and how much does that affect your inventory cost as well? And this is similar to what we discussed last time. So if you purchased and that with some discount terms, how that's going to be affecting your purchase price. If you return your purchases, how that's going to impact your inventory as well. We're going to talk about that going forward. So here, you have suppliers and you have customer. So we have another, I think this is more respect to this law or contracting. So we have something called FOB shipping point, and we have FOB destination. Okay, so FOB shipping point basically means that the title, okay, or what we call this ownership. Let me just write it clearly. Ownership passes upon the shipment. Okay, so using this example right here, on April 25th, if the contract says this purchase is following FOB shipping point, upon the shipping of an inventory or upon the shipping of the products, the ownership will change to the buyer right here. Okay. Now, if that's the case, during this shipment or for the products that's in transit, that ownership belongs to the buyer. So what that means is that the shipping cost will be a part of the purchase price. Okay. Since the shipping is not responsible, but since the shipping will fall under the customer during the shipping, following this FOB shipping point, the shipping cost will be included in the purchase price. Okay, following FOB shipping point. Now, if the contract says this purchase follows FOB destination, what that means is that the ownership or the title of the product still belongs to the supplier. Okay, the title or the ownership transfers to customer when that product is delivered at destination to a customer according to FOB destination. So if that's the case, since the ownership belongs to the supplier, the shipping cost according to based on this FOB destination will be shipping cost will be part of the selling expenses. Okay. So depending on how you interpret this contract, the shipping cost will be included either to the supplier or to the customer, depending on the terms of the contract. But again, if the contract says this is FOB shipping point, the shipping cost will be part of or will be included in the purchase price. If the contract says this is FOB destination, since the ownership is still belongs to the supplier, it will be part of the selling expenses. That's all you need to know. Okay. Any questions on this?
Professor,
Mm.
just to clarify, those selling expense, these belong to the supplier's selling expense or the Merrill's selling expense?
Which one? This FOB destination?
Yes, for the selling expense.
Yeah, selling expense will be reported under the seller or the supplier in this case, because the ownership is still belongs to the supplier during the shipment.
Thank you.
Any other questions? Okay. So which of the following transactions would increase the balance of inventory account for a company using the perpetual inventory system? Okay, so I mean, this part is not that important, but what would increase the balance of an inventory is basically the freight charges, okay, on the inventory, on the merchandise inventory. So as the shipping costs will be included in the purchase price, the inventory cost will increase by the amount of the freight charges right here. Okay. So in this example, you are beginning your inventory with 100 units. The cost of each unit is $7. So that you're beginning with $700 of beginning inventory. We saw that. Now on April 25th, let's assume that the freight charges are 300 right here. Okay, so that freight charges will be included in the purchase price of an inventory. Okay, so 300 units, $9 per cost in the contract. So they will total to 2,700, but you will also include this freight charges of $300 in your inventory. Okay, so what that means is that the inventory dollar amount will be reported 3,000 instead of just 2,700 right here. Now, if you are getting some discounts, since you are paying less, you are going to deduct the respective discount amount, $54. So that will, the inventory dollar amounts will be updated. So that's going to be 2,946. Okay. That's going to be the inventory dollar amount purchased on April 25th. Okay. So for purchase price of an inventory, you not only include this not the payment terms, be the cost of the inventory, but you're also including freight charges or insurances that are covered during the shipment or any other discounts that you get from the purchase. Okay, you include everything in your inventory cost. Okay. Any questions on this?
That's clearly described in the book, right?
Yeah. I mean, everything is from the book.
All right.
Do freight charges get incorporated into your determining of your cost of goods sold?
Yeah, of course. Yeah.
Or would you still use the $9 per unit for determining?
So I don't know. So basically, so far, let me go back to the table. So there you go. So this was an example right here. So far, we just assume that on April 25th, the company purchased 300 units for $9, total of 2,700. That was it. But when it comes to reality for the purchase, there are going to be additional costs that the customer pays. For example, it was the freight cost or freight charges that will be included in your purchase price of an inventory. So instead of using this 2,700 that we've been using so far, you are going to be using 3,000 instead of 2,700. Okay, and same idea goes to purchase discount. If the company is enjoying some discounts for the purchase, you are going to be reducing the purchase price of an inventory by the respective amount. In this case, $54. Okay.
So do you have to recalculate the unit cost with all those factored in to determine your cost of goods sold?
Yeah, I think your question comes from, so if you are including this freight charges or purchase price, are you going to be separately treating these freight charges and purchase price in your cost of goods sold calculation. But that's not the case. So basically, if I can use a journal entry, okay. So for the purchase of an inventory, let's use here. So on April 25th, you are going to be debiting inventory of 2,700. And let's just assume that the company used credit card, 2,700. So far, we have been using this journal entry. Now, in reality, the company also pays for the freight charges. So what that means is that you are going to be increasing the same inventory by $300 and assuming that you're paying cash, 300, or it could be accounts payable as well. So you're basically increasing your original inventory by $300. And also for the purchase discount, you are going to be decreasing here credit inventory by 54 and discount by 54. Okay. So at the end of the day on April 25th, the total inventory that will be going to be reported in the financial statement will be, what was the total amount? Let me just do it. So 2946, okay? This is gonna be the total amount of the purchase on April 25th instead of 2,700, okay? Any other questions? Okay. So, we've come a long way. Woo. Now, the last part of the chapter talks about now the adjustments to the inventory. Now, we're going to talk about this lower of cost and net realizable value. Okay. Now, what that means is that at the end of the year, you are going to be comparing the cost or the purchase price of an inventory and whatever you sold during the period. You're going to compare the number with the net realizable value. Okay. Now, what net realizable value indicates is the estimated, right here, selling price. Okay. Selling price minus the cost of sale. Okay, so it's the dollar amount that the company can expect to receive by selling whatever you have at the end of the year. Okay, and that's called the net realizable value. And you're going to compare that number with, I want to call it carrying value or book value of your inventory. Okay, versus. And when you compare this net realizable value to carrying value or the book value of an inventory, you are going to report whichever is lower, whichever the lower. Okay. Because like we discussed previously, accounting profession is all about conservatism. We always like numbers in lower amount. So after we are comparing net realizable value with the carrying value or the book value of an inventory, we will reduce the ending balance of an inventory depending on whether the net realizable value is smaller than the carrying value or the book value of an inventory. Okay, so for example, let's say carrying value or the book value is $10, whereas the net realizable value is $9, for example. Okay, if your net realizable value is lower than the book value or the carrying value of your inventory, you will reduce your inventory by $1. Okay. Now for that journal entry, you're going to be recording debit cost of goods sold, $1, and inventory credit by $1. $1, $1. Okay. Now, if your net realizable value is $11 and your carrying value is $10, there is no adjusting entry because you're already reporting lower value for inventory. So you're only going to write down your inventory when net realizable value is lower than the carrying value. Okay. Any questions on this?
Wait, when the realizable value is lower than book, you do a write down.
Yes, you write down.
Got it.
Mhm.
Does that have any implication on tax issues or no?
Oh yeah, tax implication. Since you are recording this cost of goods sold, that means your net income will be reduced. So if your net income is reduced, you're paying less tax.
Yeah, it's like a, is it a, I don't want to use the word phantom, but I'm going to say it, phantom expense like depreciation or no?
Mm-mm.
It's
No,
not-
it's just no. It's just, I mean, it's simple. It's just simple as that. So since you are reporting additional cost of goods sold for the write down of an inventory, your net income will be reduced, and that means you're paying less taxes. That's it.
Yep.
Just simple as that.
Got it.
Any other questions? Okay, so that's an adjustment that's made at the end of the year. What else? Ooh. So that's for the case when the company has only one inventory, and in reality, there are multiple categories of inventory. For example, you have Fund Station 2, Fund Station 3, different inventories, and you're going to basically compare the cost. So for Fund Station 2, you have a total amount of 4,500 carrying value or book value of an inventory. Now, for net realizable value, assuming that it is $3,000, okay? So in this case, Fund Station 2 has a lower net realizable value. So what that means is that you are going to be writing down your inventory by 1,500 at the end of the year as an adjustment. Now for Fund Station 3, your book value is $8,000 and your net realizable value is $9,000. So what that means is that you're already reporting a lower number in your books, so there is no adjustment at the end of the year. So in this case, since you are reporting a adjustment for Fund Station 2 by $1,500, you're going to be debiting cost of goods sold by $1,500 and lower your inventory by $1,500. Okay. Any questions on this? Okay. So here we have an item A. The cost is, let me just briefly write down. So for item A, we have a cost of 400. So 100 times 4, we have net realizable value of 800. Okay, that's 100 times 8. Okay, for item B, we have 150 times 8, 1200 for cost. For net realizable value, we have 900. Okay. For item 8, we have lower cost dollar amount. So this is good. We have lower number already in our books. For item B, we have larger. Okay, we have larger value according to our books. So we have to write down item B by 300. Okay, so the difference here. So for our journal entry, we're going to debit cost of goods sold by 300 and inventory by 300. Okay. So the question is asking, what's the amount to report for ending inventory using the lower cost of lower of cost and net realizable value. So we have ending inventory of 400, okay? And after making an adjustment, we are going to be reporting an ending inventory of $900 for item B. So in total, we have 1,300 ending inventory right here. So this is the same question. So the year-end adjustment using the lower of cost or the market will be this. Okay, debit cost of goods sold 300, credit inventory for 300. So number 8. Okay. Any questions so far? Okay, so now inventory turnover ratio and gross profit ratio. I mean, there are going to be a lot of ratio analysis throughout the textbook, but I usually stay away from the ratio analysis because I do not think the introductory accounting course should really talks about this ratio analysis. There are actually a lot of ratio analysis that analysts use to evaluate the company's financials. I mean, for example, here you have a gross profit ratio, which measures on the nominator side gross profit divided by the net sales. What does that mean? That basically means the amount of gross profit the company reports out of the total sales. Basically, that's it, gross profit ratio. So here in this case, Best Buy reports $39,000 of net sales, and out of 39, the company reports 9,000 of gross profit. So in terms of gross profit ratio, the company is reporting 24%. So what that means that out of the total sales, how much does the company report in the gross profit in fraction terms? So that's 24%. Okay. So I mean, ratio analysis, as long as you memorize the formula, you can easily calculate, but I don't have that much emphasis on this ratio analysis for introductory courses, right? And that you will deal with various types of ratios when you actually get into intermediate accounting, okay? Transactions. So I covered this periodic system. So when the company adopts periodic system, instead of reporting inventory, you are going to be using this temporary account called purchases. Okay. But for the rest of the account journal entries, it's pretty much similar between perpetual and periodic system. Now, at the point of the sale, when the company reports sales revenue, the company also reports the cost of goods sold and inventory as an adjusting journal entry. If the company follows periodic system, the company does not report the cost of goods sold or inventory because, like we discussed previously, the company does not have a continual tracking system during the period. So you're going to be reporting this cost of goods sold at the end of the period, okay, when there's a final check. So here, so at the end of the period for perpetual systems, since there is no adjustments, there are going to be no journal entries. Whereas for periodic system, that's when you are going to be recording this cost of goods sold and this freight in cost, purchase discounts, and you're going to convert everything into the inventory. Okay. So at the end of the period, these temporary accounts are closed. And then you're going to be converting these temporary accounts into permanent accounts called inventory right here. Okay. But that's basically the difference between perpetual system and periodic system. Any questions? Okay. don't want to get into this. Inventory errors. So let's do this example. An inventory error that understates the amount of ending inventory will result in which of the following in the current year. So let's just use T accounts. You have inventory right here. You have a beginning, you have purchases, you have cost of goods sold, and you have ending balance. Now, the question is saying there was an error that understates the amount of ending inventory. So when this ending inventory is understated, okay, what will be the result? Okay, so if your inventory or if your ending inventory is reduced, okay, or understated by some amount, what that means is that your cost of goods sold must be overstated in order to reduce the ending inventory. Okay, so for example, let's say you have 100, which is the correct amount. So assuming that the ending inventory is understated by 10, this is the error. Okay, if you have an error in the ending inventory, you have to increase your cost of goods sold by 10. Okay, that would have been something that will reduce the ending inventory by 10. And that's why this cost of goods sold would have been overstated by 10. That will result in the understatement for the ending inventory. Okay, right here. Any questions on this? Okay, so it's the simple math. If your ending is understated, okay, if your ending is understated, that means something is overstated. And in this particular case, the cost of goods sold would have been overstated in order to reduce the ending inventory. Okay, right here. Whew, so that was it for chapter 6. Lots of systems and lots of method. Again, I really strongly emphasize that you do calculations on your own hand and try not to make any calculation mistakes when you're calculating the cost of goods sold and the inventory. Okay, so let's just do some practice problems. Okay, right here. So during the year, the company has the following inventory transactions. You have a beginning and you have 3 purchases at different dates. So like we did previously, I'm going to create an inventory stack. Okay, inventory stack right here, 4 sticks. So you're beginning with 20 units. Unit cost is 30. On April 7th, you purchased additional 60 units at 32. On July 16th, you have additional purchase of 100 units at 35. And on October 6th, you have additional 50 purchases at $37. Right? This is the inventory stack. Now, the company sells 200 units of inventory for $50. The company sells 200 units. Why it's not working? 200 units at $50. Okay, so using FIFO, calculate ending inventory, cost of goods sold, sales revenue, and gross profit. So let's start with FIFO. FIFO. So if the company follows FIFO, first in, first out, you are going to be using the oldest item first. So for 200 units that were sold, you're going to be using the entire 20 units for $30. And you still have 180 units to go. So you're going to be using next 60 units at $32. and you still have 120 units to go. So next you're going to be using this entire 100 units at $35, and you still have 20 units to go. So 20 units to go, and that will come from the latest or the newest stack right here. So $20, 20 units times 37. So that's 600. That's, oh my God. Should be, so 19, 20, and that's 3,500, and that's 74. Okay, so 740. So in total, let me just do quickly math. 2, 5, 10, 4, 12. Hopefully I'm right. Let me just do math. Calculator. Okay. So that's 600 plus 1920 times 3,500 times 740. Oh no, I made a mistake. So that's 6,760 cost of goods sold. Okay. So we got B, cost of goods sold. Let me draw T account. Okay. T account. Oh. So T account for inventory. You're beginning with 600, okay, for the beginning. Your purchase for this, so let me just quickly add the numbers. 1920 plus 3,500 times 1,850. So the purchase was 7,270 right here. And we just calculated the cost of goods sold, which was 6,760. And at the end of the year, the ending balance for that inventory is 6,760, 11.
Sorry, where did the 600 come from?
Here, beginning. So you're starting the year with 600.
Oh, sorry.
Yeah, no problem. Okay, so this is the ending inventory following FIFO.
And the 7270, that your cost of goods sold is 6760, but and the 7270 is
The purchase price here, the sum of these three numbers.
all right. Yep.
Mhm. So this is the ending inventory. 6,760 is the cost of goods sold. Sales revenue, it's easy. 200 units times 50, so that's probably 10,000. Revenue is 200 units times 50, that's 10,000. And gross profit is revenue minus cost of goods sold. So 10,000 minus 6,760. So that gives us 3,240 gross profit. And that's for using FIFO. Okay, any questions on this? Okay, now we're gonna move on to LIFO. Come on, go up. And let me just quickly draw the same tower. So 20 units times 30, 60 units times 32, 100 units times 35, and 50 units times 37. So if the company follows LIFO, okay, 200 units times $50. You're starting with the latest or the newest item. So you're starting from the top right here. So for 200 units, 50 will come from the top of the tower. So 50 times 37. You still have 150 to go. So you're going to be using the entire 100 units times 35. You still have 50 units to go. So out of 60, you're going to be using 50 units times 32. So that's total 200 units. So that's 1650. This is 3500, and that's 1600.
1850, Professor.
Oh, this is 18? Oh, yeah, that's right. 1850. Okay. So in total, that's another 3469. Okay. So the cost of goods sold following LIFO is 6950. Okay. So if I just quickly draw the account for inventory, again, we're starting with 600 and the purchase was 7270. 7270. And we just calculate our cost of goods sold at 6950. So the ending inventory is, let me just quickly do math, 600 plus 7270 minus 6950 equals 920. So previously, we reported an ending balance of inventory at 1110 following FIFO. Now in this case, following LIFO, the company reports only 920 of ending inventory because we have a higher number of cost of goods sold. Okay. Now sales revenue is the same. Revenue is just 10,000. So for gross profit, 10,000 minus 6950, that equals 3050. That's the gross profit. So again, depending on which method the company adopts, your gross profit, your cost of goods sold, your ending inventory will change. Okay. So that was LIFO. Let's move on to weighted average. That's going to be a lot of calculations. Okay, but let me just quickly again draw the same tower. You have 20 units, 30, 60 units at 32, 100 units at 35, 50 units at 37. So in order to calculate the unit cost, okay, we first have to calculate the total cost, which is right here, 7870. 7870. And that's for the total units, 230 right here. So for the unit cost is 7870 divided by 230. That is, let me just do math. So 7870 divided by 230. That's approximately 34.2. Okay. So for 1 units of an inventory, the company will be reporting about $34.2 per unit. Now, given this number, we will first record our cost of goods sold. Now, each unit's cost is $34.2 times how many units were sold? 200 units. So that's 6,840. Okay, that's the cost of goods sold. For ending inventory, I'm not going to do T accounts because what we can do is that you have a total units available for sale at 230, and when you sold 200 units, what's left at the end of the year is the remaining 30 units. So 30 units times 34.2. So that's, whoa, 686 here. Oh, 686. Okay.
No, it's not.
Oh, what am I doing? Yeah.
It's not too.
Oh my God. Yeah, it's far off. I'm multiplying by 12, 20.
26.
Let me just do.
Yeah, 1026.
So 34.2 times 30. See, my brain is about to explode from lots of calculations. So 1026. Okay. And revenue, same, 10,000. So gross profit is 10,000 minus 6,840. So that means 3,160. Okay. Whew. So that's basically it. Lots of calculations. And my head is about to explode. And I'm pretty sure you guys are very confused or tired or just sick and tired of these calculations. But again, try to do practice as much as you can. Okay, depending on which method the company is using, depending on which inventory system you're using. The practice will help you not to make any mathematical mistakes like I made during our course. Okay. I think I'm gonna stop here. We talked a lot about this inventory system and cost of goods sold and lower of cost and net realizable value. Just please go back to the textbook and then again, try to do it on your own. It will definitely help you to calculate and to calculate the correct balance of cost of goods sold and the inventory, sales revenue, and gross profit. Okay. Any questions before we adjourn our today's lecture?